Why is the stock market hitting records while the world is falling apart? It feels like the world is in chaos, wars, oil shocks, inflation, fear of job losses, and unaffordable housing. Yet stock markets continue to break all-time highs. How is this possible? Is the stock market just one giant casino? In reality, the biggest mistake is assuming the stock market is a mirror of the real economy. The market does not measure the happiness or well-being of ordinary people. It is a machine that prices four things: future profits, interest rates, capital flows, and the forced actions of traders. Once you understand these, market records in the midst of a crisis stop seeming like a mystery. 1. The stock market is not equal to the economy. Many people think that rising stocks mean general prosperity. In fact, the stock market is just a basket of large public companies. An index, like the S&P 500, is not evenly distributed. Record highs often mean that only a handful of giant corporations are making super profits, while your rent goes up and your salary stagnates. The stock exchange is a scoreboard for those powerful enough to dominate it. 2. The market reacts to expectations, not reality. Stocks don't always rise because of good news. Often they soar because the news turned out to be less terrible than expected. If investors were bracing for a catastrophe, for example, the closure of trade routes, any easing of those fears causes a price jump. It's like getting a C when you expected a D, not perfect, but it feels like a win. 3. The money printer and asset inflation. During crises, governments flood the economy with money. When ordinary people receive aid, they spend it on basic needs: food, car repairs, paying bills. But when surplus capital settles with large institutions and the wealthiest individuals, this money goes into buying assets: stocks, real estate, gold, and cryptocurrencies. Bottom line, demand for assets grows, pushing prices up. Stock market records are often a symptom of money losing its value, with investors fleeing cash in an attempt to escape inflation and rising national debt. 4. Algorithms and derivatives. Today, the market is driven not only by people but also by machines. Algorithms don't analyze geopolitics. They look at price. If the trend changes to an upward one, robots automatically start buying. The situation is exacerbated by options, bets on whether stocks will rise or fall. When the crowd bets on growth, the major players, market makers, selling these contracts are forced to buy the actual underlying stocks to hedge their risks. This creates a chain reaction of buying that propels the market even higher. Additional facts on the topic: illusion of broad market growth. In recent years, the lion's share of the S&P 500's growth has been driven by the so-called Magnificent Seven tech giants: Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, Tesla. At times, they accounted for up to 30% of the entire index's weight. Without their success, the market's growth would seem quite mediocre. Wealth concentration. According to the U.S. Federal Reserve, about 93% of all stocks in the U.S. stock market are owned by the wealthiest 10% of households. This is exactly why stock market records have such a weak impact on the financial well-being of the middle class. Conclusion: the stock market cannot grow exponentially forever. The main question right now is not why stocks are going up, but who actually benefits from it. Record highs amidst crises are often not proof of a strong economy, but evidence of a massive redistribution of wealth. The faster assets appreciate, the wider the inequality gap becomes between those who own them and those who will likely never be able to afford them.